this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down the barriers to your investing journey from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We've recently come off the ASX week on the podcast where we spoke to 5 of the hosts from the ASX Investor Day. We loved it so much. We've got a 6th with us today.
We have. It is our pleasure to welcome Tim Samway to the studio. Tim, welcome.
Thank you. Thank you for the opportunity.
Tim is the executive chairman of Hyperion Asset Management, a $10 billion Australian fund manager investing in high-quality companies at reasonable valuations. Tim has worked at Hyperion for over 25 years, including as MD from 2012 to 2019. Hyperion has recently won 2 Fund Manager of the Year awards, and the Hyperion Global Growth Companies managed fund, now listed on the ASX, the ticker is HYGG, has returned 23.2% since inception in 2014, which is outperforming the benchmark by almost 10% per
Sounds
annum.
Good, doesn't it?
Does.
When you say it like that.
Yeah, I mean, pretty impressive CV there, Tim. So we're going to crack into a bit of an intro, as always, and have a chat around global markets and then a bit of a deep dive on Square, one of your companies that you pitched at the ASX Day. So let's kick it off with the game.
Let's do it. So, Tim, overrated or underrated? We'll throw some themes out there. You tell us your thoughts on them.
Right.
We'll start at home with our major index here, the ASX 200. Overrated or underrated?
Oh, overrated. So why? Our index is full of old world companies. And, we just think old world companies are going to struggle in the next 10 years. It's a world of innovation, and businesses that aren't reinvesting in intrinsic growth and actually delivering innovation are going to struggle. So businesses that rely on underlying GDP growth, I think are going to find it pretty hard over the next 10 years because in spite of the fact we're in a short-term rotation, looking good, bit of short-term growth, the long-term is still looking pretty average.
Overrated or underrated, the NASDAQ 100?
Pretty much the same story. Global markets are full of old world businesses. That's how they got there.
Fair enough.
Yeah, I'll just repeat the same story globally as domestically. Yeah.
Well, if we go from the old world to the new world, overrated or underrated Bitcoin and cryptocurrency?
Oh, man. So I still haven't worked it out. I mean, I actually do own some crypto myself. I own some Stellar and some Bitcoin, and my son wants me to buy Dogecoin. Can't quite do that. I've owned Filecoin. I'm just doing it to watch it. I think it's still in speculation stage. I think it's still a solution waiting for a problem.
Overrated or underrated, the idea of full service brokers?
Oh, wow. I think there's still a real need for full service brokers. Like a lot of people want to go online and just do it themselves. But, I actually started my career. I mean, I'm a chartered accountant for the first 9 years, but I did 9 further years after that, starting in 1987 with a full service broker. And I just know we made a lot of money for a lot of people over that time. So, yeah.
Fair call.
Nice.
Underrated.
And then final one, overrated or underrated Australian residential property?
Oh, man. Well, it's a touchy subject. I mean, if you're 50 and over, completely underrated, fantastic. And if you're 50 and under and trying to get further into that, so overrated, it's not funny. We all need a roof over our heads. We've got to fix that problem.
Yeah. So, Tim, we always like to start at the beginning with our guests, and that is to understand the story of their first investment, as there's likely a lesson there. Right. So can you think back and tell us the story of your first investment?
Oh, well, okay. So my first investment was, wait for this, 1974. I bought 300 Brambles Industries. My father's business partner was a director of Brambles. His name was Tom Price. And he said to me, young fella, I was 14, so I was born in 1960. He said to me, this would be a great investment for you. And I'd saved up some money doing a paper run. And I instructed my father's broker, who I worked for all those years later. I went and got a job with him all those years later. And I bought 300 Bramble shares. And I held them. I just can't remember how long I held them, but I think I bought my first car with the proceeds of those shares. So there you go. That's my first share. And Brambles are still in the Australian equity portfolio of Hyperion. It's probably been our longest term holding. I think it is, yes.
Wow.
We've held it for 25 years.
Jeez.
Wow.
There you go.
That's impressive. That is long-term investing.
Yeah, but I've been thinking about investing since 1974. Not every day in those early days.
So you've been thinking about investing since 1974. You've worked at Hyperion for over 25 years. You would have seen plenty of changes in the markets in that time. But a lot, I assume, has also stayed the same. So are there any lessons or rules of thumb that are just as true today as they were when you started at Hyperion or when you started watching markets?
Yeah, wow, compound growth of earnings is how you make money. So, and that's the hardest lesson for most young investors, is that it's patience that wins. So, buying low and selling high, that can be exciting, but actually buying a business that can grow internally, so high ROE and actually delivers internal growth over long periods of time and compounds, and you just let it happen, wonder of the world. It's just the winning solution every time. Yeah.
Yeah.
So, Tim, at Hyperion, have you developed a investing philosophy, or what is your personal investing philosophy?
Well, it's hard not to be influenced by Hyperion's investing philosophy, which has been built up over 25 years. But I have to say, look, we started with the idea that we'd invest in quality businesses that were innovative, that could grow earnings over long periods of time. Businesses with competitive advantages, great products, great services, market-leading ones that could actually steal market share from older world businesses. And pretty much we're stuck to that for 25 years. I don't think we've changed very much. We've refined at the edges. We've learnt what's worked and what hasn't. We've made a few mistakes along the way, but we've been willing to back innovation in the long term because time and time again, it's a winner.
Now, Tim, we really want to, touch on two key things in this conversation. First of all, what's happening in global markets generally, get your view on that. And then we want to do a bit of a deep dive on Square. But before we do, we're going to take a quick break to hear from our sponsors. So, Tim, there's so much noise in the markets at the moment, everything from inflation fears to, all these alternative assets hitting all-time highs, crypto, everything. It feels like there's so much going on at the moment. And we want to learn from your experience and get you to help us separate the signal from the noise. What are you watching in markets at the moment? What are you and what does Hyperion think's important at the moment?
Yeah, so clearly we're in a cyclical recovery. That's smacking you between the eyes. It was bad last year and it's getting better this year as we come out of the COVID disaster. But I think the lesson I've learned over so many years of investing and watching other clever people invest as well is that you need to frame your decisions with very long-term horizons. And so we sort of forget that the period after the war was this incredible period where governments spent a lot of money. The population expanded rapidly with the baby boom. The participation rate of women doubled and more in the US, for example, 30% to 70%. And people felt that, investors and businesses felt they could use fossil fuel in an unlimited way forever. And so they built massive machines in extractive industries to build more and grow faster. And we had this huge period of GDP growth. And that was an anomaly. That period was the anomaly. But we learnt a lot about investing through that time. That is, average businesses exposed to GDP growth was the way to make money. And then for the last 30 years, it's been going backwards. And everything that was a tailwind in those years is now a headwind. Fossil fuels, we're going to run out of them if we don't stop using them. But the reality is we're going to poison our earth if we keep using them at the same rate. So they're going to be constrained. We're in the opposite of a baby boom. We've got an aging population. And Population growth is what makes GDP grow. And we've got governments that are drowning in debt who are going to have to deleverage at some point in time. So there's a whole lot of things moving against, long-term GDP growth. So all those worries about inflation and thus interest rate rises, we think actually are very short-term. We think over the next 10 to 20 years, inflation won't happen. For all the reasons I've just said, plus innovation and disruption are making products cheaper. Renewable energy is a technology. It gets cheaper. There'll be a point in time where the marginal cost of energy will be free. Yeah. So, and in the past, inflation's been caused by things like wage rise pressure. Well, the middle class who have been able to apply all that pressure in the past have been gutted around the world, Western economies. The middle class has been sent, their jobs have been sent offshore, they've been outsourced, they've been sent to the gig economy, and now they're being replaced by artificial intelligence. So, we just don't see taking the longer term frame that the next 20 years looks anything other than GDP growth low. And that's why you've got to buy innovative businesses that can grow their earnings at above the rest of the market. It's why I made that comment when you asked me about those indices. They're going to struggle for the next 20 years. You've got to be much more careful in your stock picking.
So speaking of stock picking, we talk about the importance of building a thesis here at Equity Mates. And in your ASX presentation, you spoke about how to go about building an investment thesis. So are you able to share, what you discussed and how do you actually build a thesis for a company?
Sure. Well, what I did say at the ASX is that there's a lot of work and 25 years of experience. So
let's forget about that part.
Compressing that into
what's the cheat sheet?
A 3-minute grab is pretty hard. But your questions that you've got to ask yourself is: are you prepared to buy a business that's just going to grow because the underlying economy grows? Yeah. Or are you going to buy a great business that can grow faster than the economy? Are you going to buy a business that's in a headwind, or are you going to buy one in a tailwind? So the best business in coal and oil at the moment is actually going to struggle in the future. You can just see that, yeah? Okay. But businesses that are exposed to really strong tailwinds, like the move from cash to cards and digital payments, cloud computing, e-commerce, those ones are in tailwinds. And so you buy a good business in a tailwind and it's going to get a lot easier. And then that final point is innovation. We back innovation because innovators, time and time again, just manage to surprise on the upside. They come up with some clever idea and hey ho, it's worth money. Amazon's a classic example of that. Great business, but actually AWS was inside it, generating tons of cash.
Now, you've mentioned innovation and disruption a few times, and Hyperion is very focused on those companies. I think some of the biggest holdings in your global fund are Tesla, Square, Amazon, PayPal, Spotify. Very disruptive, very innovative companies. But it feels like every company these days wants to use machine learning, AI, innovation, disruption in their media releases. Every company wants to be seen as that. So what's your process for figuring out distinguishing the wheat from the chaff? What companies are truly innovative and which ones are just doing it in their press releases?
You've got to measure it at the potential sales line. That is this an innovative product that is going to drive long-term revenue growth for this business? And will it be a product or service that can steal massive market share and ideally grow the total addressable market as well? So there's a whole lot of things where the product comes in, it grows the whole pie because it suddenly becomes an area that everybody goes, wow, we should have been doing that. And then because they're the first mover, they actually grab the largest slice of that pie, and then they go on to keep increasing their slice of an ever-growing pie. So cloud computing is the classic example of that, and so is e-commerce.
Yeah. That growing the total addressable market, what Airbnb and Uber did is just phenomenal. 100x the market and own it.
Yeah. And look, and then there's the execution risk. And so there's a lot of businesses who try and do that and never make a profit. So I will add the second half of that is we need the line between that increase in sales and eventual earnings, which is what we're there for. And so businesses like Uber, you wonder whether they'll ever, Whereas businesses like Spotify, they've gone from loss, but they're moving very rapidly into profit.
So Tesla has been the largest holding in the global growth
And still
fund.
is.
And still is?
Yes.
Okay, so given that its market cap is larger than the rest of the auto industry combined,
Yes.
what is the thesis for Tesla going forward, particularly as we now have Volkswagen coming in and
Sure.
saying their
It's
piece?
market leadership. I mean, it's the same story. It's years ahead of its competitors. Okay, so if you just look at a car and a car, okay, so they both look like cars, but actually as you start pulling it apart and looking at the customer experience, I own a Tesla. I mean, seriously, it accelerates like a $600,000 Ferrari. I still feel like a boy.
We should take it out after this.
Yeah, well,
We also need to get a $600,000 Ferrari to compare.
yeah, well, that's right. That's right. Well, I've driven both, and I can tell you the Tesla's more fun to drive.
Wow.
But it's also the way that it just continuously updates. I mean, I've had a couple of German cars over the years, and I've had one car where 3 or 4 years after I bought it, I said, "Hey, there's all of these new roads in Sydney, and my GPS, can I get the update?" "Oh no, we don't have an update for that." I was like, "Hang on, you've just made a whole part of my car, which I use all the time, completely worthless." Well, the Tesla just updates overnight, all that sort of stuff. That's just clever thinking. But it's more than that. It's the way they've designed every part of the car, and then every part of the software, and then every part of the distribution system. So, dealers don't want to sell EVs. Traditional dealers. Why? Because there's no servicing. And that's where they make their money. So traditional automakers have got lots of problems in getting to the stage where they're really competing against Tesla. And that's why it's worth so much, because we think they can maintain that market share over a long period of time while the total addressable market really expands quickly. And if they can keep that market share as the total market expands, the uptake of EVs increases, the profits will flow.
So how do you think about companies like Volkswagen who are trying to, I guess, internally disrupt themselves and quickly start competing with Volkswagen?
Well, they have to. They've been left behind, and they've been left flat-footed, and they have no choice to do this because their vehicles will be completely redundant in 10 years' time. So they have no choice to do so. But they're losing money on cars they sell that are EVs. They're going to have to discount them to really get them out the door. But we think it's great they're doing it because it validates the whole thesis that the whole world is going to turn to EVs. So we're not against, good on VW, good on BMW, good on all these car manufacturers. Get on with it, because we need that total addressable market to expand quite substantially.
How do you think about Elon Musk buying $1 billion of Bitcoin?
I think it was $1.5 billion.
Yeah.
And look, it's a rounding error on their balance sheet, and it's great PR. Would I have done it in the same circumstance? You've heard my comments about Bitcoin. Probably not. But he's doing 99% of the stuff that we'd like to see really well. So the execution is amazing. There's virtually nobody that's taken a car company from where it is to the quality of the build that they produce now in that time, and innovate so quickly, so rapidly.
And started a space company.
Yeah.
On the side.
And solar panels, and and batteries, and everything else, and have time to think about Mars. Yeah.
Elon for me and Tesla is just the classic example of signal and noise. There is so much noise around Elon, smoking weed on podcasts, tweeting things, moving to Texas, all this random stuff, COVID conspiracies, whatever it is.
Yeah.
But the signal underneath it all is he's executing on two incredible businesses.
Yeah.
Absolutely.
Crazy.
Seriously, he's landing space vehicles back and reusing them.
Yeah.
I mean, I read something the other day. I mean, it's like a jet that flies from Sydney to Los Angeles, and you just dispose of it after it gets there.
Yeah.
I mean, seriously, that's the sort of dynamic he changed. That's how they used to think.
Yeah.
That's crazy.
Bill Gates a couple of years ago said you wouldn't mistake Elon Musk for Steve Jobs, and I think when all is said and done, Elon might go down as better.
Yeah. Well, that's right.
If he gets us to Mars.
Yeah.
Be amazing. Yeah.
We want to do a deep dive on Square, but you mentioned Spotify there, and Spotify is an interesting company that would just touch on quickly before we
Yeah,
get to Square.
sure.
We're both big fans of Spotify. Obviously, they're big supporters of the podcast game, so we have to be fans. But they haven't had a great year from a share price perspective, and
Great, we buy cheaper.
yeah. So
Because they're dominating. So
Yeah,
they're rapidly approaching 400 million users, monthly active users. The number of subscribers is really increasing. I think that they've the Hyperion view is that they've won the war of on demand. And it's because, their algorithm or their algotorial, I think they call it, which is sort of serving you the music that you want to hear, as opposed to Apple, who says, like, here's 60,000 new tracks today, go find. Yeah, and that's just that's impossible. Whereas Spotify creates the sort of soundtracks that, I know what you like. I'm watching what you're listening to. That's a bit creepy, but actually here's something you might like. And time again, I listen to Spotify almost exclusively now. My only problem is my 12-year-old son gets in the car every now and then because Spotify runs natively on a Tesla. And he listens to Russian hard bass. And so every now and then Spotify offers me some really weird stuff. But it's clever. It's clever. And, it's just what I was saying before is that we want a great product that we think can actually increase the total market. And there is a shift. That's a thematic shift that Hyperion is following. The move away from linear radio and television to on demand. And so we own Roku and we own Spotify in the portfolio.
Yeah. So on the Spotify story, it's obviously growing top line revenue incredibly quickly. It's taking market share. How do you think about these companies, and when do you want? Are you happy just to wait and have them reinvest for growth and lose money year after year, or at some
not
point?
Forever. But we have a 10-year. We take a 10-year view.
Okay, yeah.
So that's where I think we're different from most fund managers. We're prepared to take a 10-year view, and there's not many businesses out there you can really take a 10-year view on. It needs to be a business that looks like it's to us that it's going to dominate whatever segment it's in. Yeah. It's going to be the winner takes most. They're called power law relationships. They're the sort of, why do the top 10 sportsmen earn 100 times more than the next 10? Yeah, it's that sort of thing. We think power law relationships actually exist in businesses as well. And increasingly, these businesses become winner takes all or winner takes most in their particular markets. So we're looking particularly for winner takes most type businesses. And that's why we think we can look 10 years forward. There's more probability about the earnings.
I know we've spoken to Alex Pollock about Roku. Roku. What is your thesis very similar?
Same. I've listened to Alex talk about Roku. Yeah. Our thesis is the same.
Yeah. It's an interesting company.
It is. It's one.
I don't know if I'm sold on it, to be honest.
Really?
Yeah.
Or do you want to have it out?
Oh
here?
no, you need to use it though. Seriously. Yeah. What's special about a lot of the businesses that we own? They're not capital heavy. They're capital light. You can test most of them from your home or your desk. And that's increasingly becoming the sort of product that consumers use, the ones that they can use from their phone, their desk. We've gone from, when I started work, I just want to put this in perspective, in 1978 as a young trainee chartered accountant, my job included things like going down to the post office and getting the yellow pages of a city that wasn't where we were living so that the senior partner could look up a business and perhaps recommend to a client a business they could use in Melbourne, for example, because nobody kept the yellow pages for Melbourne or Perth or Adelaide. Can you even imagine that these days? You've got a supercomputer in your hand. You just go bip, bip, bip like that, and Amazon does it for you. Like if you're looking for a product, you just want the cheapest one. You don't care where it comes from. And logistics have changed, so you can get something delivered from Perth at the same time as you can get something delivered from China or Los Angeles. So I think things have changed.
Yeah, absolutely. I am a fan of the thesis behind Spotify, though, so I'll let that be known.
Right. Good.
Doubled down on them recently. So before we move on to a deep dive on Square, Tim, we'll take a quick break to hear from our sponsors. So, Tim, at the ASX Investor Day, you pitched Square. It is the second largest holding for Hyperion at the moment?
It might switch around with PayPal from time to time in the last month or so. Yeah.
So payments a theme.
Payments are the theme.
So for those that are not familiar with the company, can you tell us a bit about it?
Yeah, so So most of you would have come across those little white boxes that sit on merchants' desks, that and they suddenly became very popular, in the March last year when everybody realised that nobody wanted to handle dirty, COVID-infected cash, and a lot of merchants ran out, and you can go up to Officeworks and buy one for $400 and something bucks, and you can be operating that afternoon accepting credit cards. So that whole seller ecosystem comes with a whole lot of other benefits. So it has a point of sale system, which whether you're a restaurant or a retailer, it's different. It's particular to those type of merchants, and they do payroll and they do appointments, and it comes with the ability to borrow. Because Square can see your sales and your cash flow and actually gives you a pretty good idea. And lots of small businesses really struggle to get short-term finance from banks. But if that were the only story, we probably wouldn't own it. The second part of the story is something that doesn't exist here in Australia yet with Square, is the Cash App. And it's the ability of young people who are relatively underbanked. So, we think there's 60 million Americans who are underbanked, don't have credit ratings. A huge proportion of those under 30 don't have credit cards. My daughter's 17. She doesn't want a credit card. She said, "I'm not going to do that. I don't want to have I don't want to run up a balance that I can't pay at the end of the month." So, isn't it funny that millennials are actually cleverer? No, they're getting very clever. But what they'd like is, because they're using their phones for everything, is an ability to do it all online. And so the Cash App allows you to get your weekly pay paid into the app. Any largesse that comes from the government, any stimulus, can be paid into the app. You can pay your friends, your family directly, P2P, but you can also tap and go. You can buy stocks. You can buy Bitcoin. You can make term deposits. It's becoming super app. It'll do everything eventually. They'll just keep adding bits and pieces to it. People say to me, "You can buy Bitcoin on it?" And I said, "Well, yeah, I'm not quite sure how much money." This is last year. We were buying it in March, April last year. We'd been watching it for a while. And we realised that thematic was going to get very strong in the middle of COVID, like the movement to cards and digital payments, and especially as e-commerce took off. And I've just been watching the amount of Bitcoin turnover that's going through Square. I mean, it's ridiculous. It's gone from sort of 1 billion. I think their last quarter was $3.6 billion US dollars worth of turnover. I mean, they only take a clip on it, but still, that's innovation. Yeah. Can you imagine an Australian bank actually responding to the demand and having a product like that in short order?
So to confirm, it's not actually linked to a bank account. It is acting as a bank account. Yeah,
effectively, yes.
Yeah, right.
I mean, lots of things now link to a bank account. That is, you can take money to and from it. I mean, that app I use for my $1,000 worth of Bitcoin because I'm testing it. That's just a link, so I can just press a button and it whacks $1,000 out of my bank account. It's not so much bank accounts; it's credit cards that the young are finding it hard because they can't access credit ratings, and credit ratings are very important in the US. It's why we think businesses like Afterpay, buy now, pay later, will continue to grow because that's a whole demographic that use it regularly.
I saw PayPal launched a credit card yesterday.
They did,
Was it yesterday?
Yeah.
I don't know any details about it other than that.
Yeah, no, early days. I mean, we don't see the death of the traditional credit card companies. They are the rails on which a lot of this stuff works. But Venmo is the PayPal version. It's aimed of the Square Cash App. It's aimed at a higher socioeconomic level. A more affluent consumer. So like each have got its own. It's got its own level, and that's why we think there's room for two players in that market, and that's why we're backing both.
Yeah. Square is a fascinating business. Full disclosure, I've been a long-term shareholder. I don't think you are. No. Maybe we'll be after this episode.
Maybe. Buying right now.
What?
Through the Cash App.
A lot of people probably wouldn't be familiar with the fact that Jack Dorsey wears two hats in his day-to-day life. So the CEO of Twitter and the CEO of Square. How do you think about a CEO wearing two pretty big hats? Yeah,
well, look, it's a great question, and it's one that we've had to address on a bunch of companies we own. So Jeff Bezos, Elon Musk, Yeah, so we'd actually prefer that, it's all in the execution. If they're executing well, like tick, you know, we're aware that there are potential problems, and we'd obviously be aware of the potential conflicts of interest. But hey, these guys are very driven to succeed in everything they touch, and we love founders that are ridiculously engaged in the execution. I mean, I've heard Elon Musk interviewed a number of times now. You listen to that Sandy Munro podcast. Sensational. He knows everything about every part of the car. He understands the metals and how they work together, and the power that you get out of a motor, and how it's like right down to the tiniest little detail he's been across, and he's done the same thing at SpaceX. Well, that's the same with Dorsey here. You know, he's right in the weeds on this stuff.
Yeah. So when you think about the competitive landscape, obviously with a lot of these companies in the disruptive space, it's moving pretty quickly, and particularly in payments at the moment. Where does Square sit in, I guess, the domestic landscape in America and globally?
Well, its penetration is only about 3%. So it's very early days, you know, like they might have tens of millions of users, but we think they're only 3% penetrated. So, you know, it's the addressable market, the total addressable market's 145 billion. And they're only just a small way along the way. So we actually think, you know, lots of upside. And to your point, though, we are constantly scanning the horizon for potential disruptors of disruptors, because that's really what can go wrong. Yeah. So we spend our lives thinking about what can go wrong with a thesis and who's going to disrupt this one. If it's so good, the crows land. Like when you see a business with return on equity above 25%, everybody else in the market's looking at it thinking, I could do that too.
Yeah, this is a question that Alec and I were discussing after a recent interview. You know, a lot of fund managers come on and say we're investing in disruptive businesses, and more frequently they're just all becoming the same businesses that everyone's investing in. So at what point do you draw the line and say, this is the norm now, and we need to look for, as you said, the disruptor of the disruptor? There are
plenty of disruptive businesses, no doubt about it. Like, simply must be thousands and thousands. We're looking for those few where the winner will take most. Yeah. And we hold them in our portfolio at a pretty large weighting. Like, you know, Tesla's in there at 12%. Square and PayPal are around 8% holdings. We think the worst mistake a fund manager can make after doing all the work and really holding high conviction is to hold something in your portfolio at 2%. Yeah. Because if it doubles, you've only added 200 basis points of performance.
Yeah, true.
That's a disaster. We've had stocks in our portfolio like REA. It's a 100-bagger.
Yeah.
Wow.
And I've had other fund managers, when the stock was $19, say to me, that's just a website, I'm shorting it.
Yeah.
Yeah.
Rookies.
100-bagger, that would be nice. Yeah. One day we'll get a 100-bagger.
So you don't have any mandates then on position sizing?
Maximum 13. We 12 normally stops at cold.
Okay. Yeah.
But 13 max.
Okay.
So one thing about Square is that it's an incredibly difficult regulatory environment to navigate for them as they try and expand globally. I saw Jack Dorsey in a video, like an all-hands meeting. Someone asked him about why they're not moving faster, and he turned that into, this is why Bitcoin is so good, because it's like a global protocol that, you know, would allow them to roll out a lot quicker. But that's not the world as, that might be the world he wants, but it's not the world as it is. And Square has to go country by country and navigate regulatory approvals. I think you mentioned Australia specifically.
Second largest market for them.
Yeah, but he was saying
a challenge. Like, you know, our regulatory, like we can't get a cash app like that.
Yeah, and he was saying that the banks have a lot of power here, and that they own a lot of different parts of like the financial world that isn't the same in other countries. I think he was talking about the payments processing. Yeah. So how do you think about that?
Well, that's why, as I said earlier, the rails that exist with the MasterCards, the Visas and the banks are going to exist. But increasingly, banks are just going to become back office processors. You know, they'll lose the relationship with the customer and they'll become utilities. And that's how we look when we look 20 years forward, is that the banks are really going to struggle to maintain that relationship, because let's face it, they're just not producing the services that customers want. I mean, that's where Square really is doing a wonderful job. It actually says, what would a customer want? Yeah, and delivers it to that customer.
So, but in terms of the regulatory environment, like, do you have to really temper your expectations of how quickly they roll out and stuff like that?
Of course, yeah.
And then, in terms of projecting, like, do you look at every country differently? I feel that would be a lot more analytically difficult than looking at Spotify.
Of course.
Yeah.
Well, but Spotify's in, I've just forgotten how many countries it's in now, but it's a ridiculous number. I did know the number, I just can't remember it off the top of my head. And there are challenges in every country you go to, cultural challenges and currencies and and tax, and so it's not easy. But actually, that's why one of the things we see with a lot of businesses, we think they're, and the ones we like, is that they are transferable to other countries, but not every country. Yeah, I mean, look at how Facebook tried to get into China. And just
any large
or
Western
Uber
tech
tried
company.
to get into China.
Yeah, but I mean,
Google.
Facebook's big opportunity was to take it to the WeChats of this world, and it just never got there.
Yeah.
So, Tim, before we move to the final three questions, just want to remind the Equity Mates community that if they've enjoyed listening to what you have had to say, the Hyperion Global Growth Companies Fund is listed on the ASX, and the ticker is HYGG. So if you'd like to back what Tim and the team are doing and I guess get access to the fund that they're building, head over and have a look at that. HYGG is the ticker.
There's also an Australian fund. Is it listed as well?
Not listed.
Okay.
No, it's on M Fund.
Yeah, right.
Yeah, but I mean the ETF is the choice.
Yeah.
It's just so simple. You get right in at NAV. It just trades like a normal stock.
Yeah.
And that portfolio's that one that has got 1.4 billion in it. So it's not a startup. It's actually been running 7 years now. No, it's very simple.
Yeah.
It's just another door. The ETF is just another door to that fund that's been running as a managed fund all that time.
Yes, it is a managed fund. So HYGG, Hyperion Global Growth Companies. But as I said, Tim, always finish with the final three, so we'll get stuck in. Yeah,
so the first question that we like to finish with is, do you have any books that you consider must read?
Man. So, like at Hyperion, everybody reads a lot. And I have to say the investment team, if I look through them, have just like, they've got books and books and books, and they're all investment books. I'm a little different. So that's a great question. Must reads.
Doesn't have to be investing related.
No. Well, I mean, there's clearly a bunch of big investment books that you just have to read, and I'm not going to go through those because I think you can work out who they are. Books that I read when I was young that I've remembered, and I still can feel how I felt when I read them. So my cousin Stephen was killed in the Vietnam War, and when I read Joseph Heller's Catch-22, it really struck me about the futility of war. I mean, I think that consolidated my views about war and personalised them. Catcher in the Rye, J.D. Salinger, I read that as an 18-year-old. I remember laughing so hard in that book. I still remember the feeling of laughing that hard reading the book. And what else? Reading books to children. I never read Roald Dahl as a child.
Oh, yeah.
And we were on a holiday when my daughter was about 6, and I read her Danny, the Champion of the World. And if you know that book, it's a story about a father and a son and their exploits, and I won't go into all the detail. And it's written from the position of Danny the boy, but Roald Dahl does a very clever thing in the last page of the book, and he's narrating his conversation with his father, and then he subtly switches it to a communication directly to you at the reader, and you don't see it coming. And he says something to the effect that, so what I've been trying to tell you is quite simply that my father was the most amazing and exciting man that any boy would be lucky enough to have. And I still feel it now. I remember, because you're reading to a 6-year-old, so you don't read too fast, and you're reading ahead. And of course, as I read that paragraph, my throat just closed. I'd lost my father the year before, and I just couldn't say another word. And I just handed the book to my wife and said, finish the last paragraph. And I just think reading is one of the most important things you can do in your life.
Yeah, agreed.
Yeah. And I say, go on the last question, because I think that leads into the last question.
Okay, all right. Well, before we get there, we have a second last question, which is, in 60 seconds or less, what's the best company you've ever come across?
Oh, Amazon.
Amazon?
It's just a cracking business. I mean, we bought it in 2014. It's a monster. It's changed the way everything works.
Nice.
I mean, really. And then, AWS really set the scene in cloud computing. Whether or not you like Jeff Bezos is kind of irrelevant, really. There's lots to not like about him and lots to love about him. But the fact is that Amazon really has changed the world from what I knew prior to the internet really coming on the scene prior to 1995. Like I can just see chalk and cheese.
Yeah. And then final question, if you think back to your younger self, buying those first Brambles shares in 1974, what advice would you give your younger self?
Yeah, so read and read and read and learn. Learning never stops. I am still learning. I'm 60, and I'm still building businesses. So, I'm building another funds management business at this, in cattle and carbon sequestration and soil regeneration, and another business that's doing carbon rating of public companies. And it's like just never stop growing, learning, and thinking about what you can build in the future.
I feel there's a whole other interview we could do at some point on that business that you're building. That sounds really interesting.
Oh, well, we could do that.
Well, Tim, we'll have to get you back for interview 2.0. But it's been a really enjoyable conversation. Thank you for joining us this morning. And I know that a lot of our audience would have taken a lot of value from that. A lot of the stocks that, we're all very interested in. So a reminder, HYGG, check it out on the ASX. But very much appreciate your time.
Thank you very much. Thanks, you.
Tim.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander people today.